and I want to continue along the issue that the Chairman has raised, in particular about the pricing strategy for standard variable rate loans and variable rate mortgages. You're currently charging in the region of 4.5% for a new mortgage if the LTV is over 80%. And my question, Mr. Boucher, is how can you justify that when your stated cost of funds are 1.15%? Which have come down by about 30% in the last 12 to 18 months. Your margin has increased very substantially. Most people would regard a variable rate product as one where if the market conditions are bad, the rate's going to go up. But when the market conditions are good, people expect the variable rate to come down, and that simply hasn't happened. So I want to ask you, when was the last standard variable rate reduction by Bank of Ireland in respect of mortgage products?
I think the last reduction would have been about 2008 or 2009. There's been a significant interest rate cycle in that period of time. The group's net interest margin has improved. It's improved in the 12-month period from 1.65% to 2%, just over 2%, 2.08%. That is progress, but it's certainly not an exorbitant margin. It is we have to get 98% of our credit decisions right before we can make any money or cover our costs at that prediction margin. But I think it is also important, as I was trying to identify in the answer to the Chairman's question, Deputy, is the structure and liquidity risk you take against mortgages. We're providing a mortgage which has a significant liquidity risk. We have a repricing opportunity, but we are giving a 25-year commitment to the customer of money. We cannot raise that money. So it is not necessarily comparable to look at our overall cost of funds. For example, if we're doing a covered bond or we're issuing unsecured debt in the markets, we're issuing it at about 2 to 3%. The Irish government, raising 15-year money in the market, is raising it at 250 basis points. So you have to look at the nature of the product you provide, the liquidity risks, the historic credit losses you take, and the capital you apply. So there's a range of factors in there. We have to enhance our margin, but we do try to ensure that our products are competitive on an ongoing basis. We're a commercial business, we operate in a competitive market, and we must ensure that our products are competitive, sustainably competitive, that we can continue in the market, that we can attract customers, and that we can do business.
Okay, I would make the point to you that your margin has increased very substantially. Your cost of funds has reduced very substantially by about a third in the last 12 to 18 months. And yet you're telling me it is about 6 years since Bank of Ireland has reduced the standard variable rate being charged. Now, one of your main competitors, AIB, have stolen a march on you in the market and have reduced their rate. And presumably you will have to follow suit. You won't confirm that today, but the market will dictate your reaction ultimately. But I would submit to you that you are taking advantage of variable rate customers. They are being exploited. It will come as a surprise to nobody that a bank seeks to maximise profits, but you are profiteering on the backs of variable rate customers. And you made the comparison with the UK market, which you said is the best comparison with Ireland. Well, if I drive across the border today, you're offering a 1.98% fixed rate up to January 2017 if I have a low loan to value of 60%, 2.09 fixed rate for at least 2 years if my LTV is 75%. You're offering a variable rate for the same period of time of just over 2%. Now, we know there's a much more competitive environment there, and after 2 years, if Bank of Ireland doesn't keep the rate low for that customer, they will switch. They can switch to another bank. They don't have that option here. So how can you justify such a massive difference between the rate you're charging in the Republic, the rate you're charging in Northern Ireland and in the rest of the UK, given that you have said both of those markets are remarkably similar?
Factual matter, Deputy, our average rate on new lending in the UK, in our UK mortgage business, which is a growing business and is developing, the average spread or customer to customer is between 3.99 and 4.5%. So that's a factual matter.
Yeah, but the rates that you're publishing, they're advertised rates. You're offering a fixed rate of as low as 2% and a variable rate of just over 2%. Now, it's for a defined period of time, and it is if people have a relatively low loan to value, but it's much more competitive than what you're charging here. And
if I could also note your examples you've quoted of fixed rates as well. so we can buy fixed rate money and we offer fixed rate mortgages. We are still surprised at the lack of take-up of fixed rate money in the market. We note the Irish government has made a decision that is going to try and fix rates in the period. We try and offer attractive fixed rates, and we would encourage customers to look at fixed rates. A fixed rate gives a customer certainty, gives a customer control of their finances in so far as possible, and we provide attractive and competitive fixed rates. Like you said, Deputy, we operate in a competitive market. We review our rates on an ongoing basis, and we also bear in mind our responsibilities to all of our stakeholders, our depositors, our shareholders, the taxpayers who we repaid. The strategies of other banks are something we keep an eye on. But what we learnt in the past, Deputy, is that we don't slavishly follow the strategies of other banks. We look at other banks, we look at the sustainability of their propositions, we look at their ability to attract capital, to fund themselves, and to meet all their commitments to all of their stakeholders.
So has Bank of Ireland any intention of reviewing its standard variable rate on mortgages in light of the current market conditions?
We look at what competitors do and we review our rates on an ongoing basis.
Okay. Is the bank open to switcher mortgage applications? If I'm with another bank, I'm in a healthy financial position and I want to transfer my mortgage to Bank of Ireland, are you open to that?
Sorry for interrupting. Sorry, members of the committee can't talk between themselves because it's actually disrupting other members listening to what's being here. Thank you.
I'll ask my colleague, Mr. McLaughlin, to assist you there, Deputy.
Deputy, yes, the Bank of Ireland is certainly open to new business from switchers from other banks. The track record has been, however, that the Irish market is dominated about 60% by tracker mortgage rates. So actually, the inclination to switch mortgage in the Irish market is not as it is in other markets. But we are certainly open for business and very keen to switch business in the Bank of Ireland.
I was asked of you before this committee. You have said it's a very low proportion of your mortgage business.
That is the fact, Deputy, and the reason why it is so low is the keenness for people to switch mortgages when 60% of the market is on tracker rates is low, and therefore actually the quantum of switching taking place in the Irish marketplace is low as a result of it. But we are very
switcher products, but the desire of the customer to switch when they're on a tracker to a variable or fixed rate is low.
I would just say to you, Mr. Boucher, I don't find your argument about pricing policy terribly convincing, because you were the one who drew the comparison with the UK market, remarkably similar to Ireland, and you have said the average rate that you're charging there is around 4%. But when you look at the offering that you're making to new customers up there in Northern Ireland and in the rest of the UK, it is remarkably competitive, and it is strikingly different from the offering that you're making here. The rates you've provided to us, 4.5%. You know, and at a time when your cost of funds is probably down around 1% now, that's a remarkable margin that you're charging on variable rate products, not just on mortgages, but on personal loans where you're charging about 12%, on credit cards where you're charging about 20%, and on SME loans as well. They're paying way over the odds here.
Yeah, I'll point out that the group margin is 2%. We have to take into account liquidity risk, in particular for mortgages. Like I said, it's a 25 to 30-year proposition to customers. So we have to take a liquidity risk for 25 to 30 years. The Irish government has taken out a 15-year bond at 2.5%. So, you know, it's very difficult to compare. If we're talking about a matching of one product or one product feature with another, our group margin is 2%. We have to have subordinated capital. We have to have a range of different instruments of different maturities and different lifestyles to match our different products. We also have to take into account, and we're required to take into account, the weighted cost of capital against products, which also has to take into account loss experience. Our loss experience in our UK mortgage book is different. But to assist the Deputy, we will provide you with our UK mortgage rates and our Irish mortgage rates, so that you have an appropriate comparative.
Thank you. I'm on my last question. I've been signalled. It relates to Bank of Ireland's approach to dealing with insolvency cases under the formal Irish Insolvency Service. And the slide number 40 that you have provided to us is showing that of the total of 296 personal insolvency arrangements, Bank of Ireland is involved in 109 of those, if I'm reading it correctly. Lapsed with no creditors vote 9. So can you just confirm to the committee how many personal insolvency arrangements has the bank signed off on, which has involved a material change to the mortgage balance? because you informed us before that the bank would not sign off on any PIA which involved a change in the mortgage balance.
I'll ask my colleague.
Deputy, okay, again, turning to slide 40, as you referred to, there have been 296 protective certs, as you say, issued in relation to personal insolvency, 109 in relation to cases where Bank of Ireland were party to. Of the 109 cases, 9 have lapsed. There was no creditor vote on it. The work in progress cases still at the end of September were 41. There were then 45 cases in which the Bank of Ireland voted yes, and there was 14 cases where Bank of Ireland voted no. So of the cases where the Bank of Ireland voted in favour of the proposal from the PIP, it was 76%, and that compares with, in overall terms, 67% of arrangements were approved. So our number was 76 compared to an average of 67 across all cases.
You approved cases which have involved a reduction in the mortgage balance. No, Chair, I asked that question and it wasn't answered. Have you approved cases? Have you approved cases of PIAs proposed by PIPs which have involved a reduction in the mortgage balance?
Yeah, I don't have the specific with me, but actually in each of the PIP cases there is negotiation about the terms and conditions and the outcome in relation to it.
Hold on a minute now. There was a very clear policy stated on the last occasion you were here. So I'm asking the question.
I wouldn't be aware of what we have, but we can't confirm that, so we will verify.
But is it still the bank's policy not to sign off on any PIA that involves a reduction in the mortgage balance?
The bank's policy is to ensure that secured mortgage debt is prioritised, and our policy is to maximise the recoveries. So that hasn't changed. That has been consistent, and that consistency of policy has ensured that our defaults are half the industry average, that our defaults are going down,